Good morning, everyone. Thank you for joining the Access to Capital panel. We are going to start first with a couple of quick polls just to identify who's generally in the audience. As we go through these polls, after that we will do some bios of the panelists, and then we'll go through a slide and then start talking through our general presentation. At any point, please feel free to use the chat button down below. If you have questions at any point, please use the chat and we'll try to answer them as best we can. But why don't we start with a couple of quick polls for those that have joined on. Okay, so it looks like a majority of us are with small businesses or representing small businesses. Roughly a third are representing middle market businesses, and about 14% service providers. So that was very helpful. Why don't we go to the second poll that we have that will go through general topics that we can discuss and just find out what's going to be most interesting to you. Okay. So it looks like understanding different types of capital, about 15%, raising capital in the current environment, about 30%, M&A, about 30% as well, and then pitfalls around 30%. So we will make sure that we spend time on those as you have specific questions as we get through our general presentation. Please feel free to ask those, but we'll try to pay particular attention to these areas. Why don't we start then? We can remove the polling questions. My name is Jeff Michalczyk. I work for CIBC. I'm also the father of a 16-year-old and 14-year-old daughters. We are living at home right now, everyone doing remote learning. I think this morning we had my wife on a Zoom call, both my daughters on school Zoom calls, and my brother-in-law, who's been living with us through the pandemic, also on Zoom calls. So pretty incredible that our Wi-Fi has the bandwidth that it does, but hopefully everything works well today, and we can get through this without too many technical glitches. My background is with in commercial banking. I've been with CIBC now for a little over 3 years. Prior to that, I was with the private bank, which was acquired by CIBC, and I joined a private bank after being with LaSalle Bank for about 11 years. So I've been in banking for about 23 years now. And really with the same general team. A lot of individuals that I started with at LaSalle made the move over to private bank together and are now running CIBC USA. I run a group with 3 teams as part of that. One of the teams is general commercial and industrial businesses, middle market type businesses. I also lend to both commercial finance and consumer finance businesses. Commercial finance businesses being merchant cash advance businesses, factoring businesses, asset-based lenders, leasing companies. So a variety of different alternative providers of credit to small businesses. So Patrick, why don't you introduce yourself?
Yeah, appreciate that, Jeff. So Patrick Osborne, I've been from the Chicagoland area, grew up in Winnetka, and then now I live in Chicago with my wife and daughter. I've spent about 9 years in banking, the first 7 at Northern Trust, where I went through credit training and covered a combination of, everything from large corporate companies to small businesses. And then I moved over to CIBC 2 years ago and joined Jeff's team. And when Jeff was talking about the different kind of areas of focus, I'm primarily focused on those commercial and industrial clients. So providing revolving credit facilities and term loans to Chicagoland middle market companies with $5 to $50 million in EBITDA. And then I work with my other banking partners on providing other services, whether it's treasury management or capital markets products for those companies, or working with the private bankers and providing services to the business owner. So looking forward to the panel today. Thanks for the opportunity, Jeff.
Great, thank you. Nishad, how about you give your background?
Thanks, guys. So thanks everybody for being here. My name is Nishad Parmar. I'm the Senior Partner and Chief Investment Officer for Allowed Capital. We're a venture capital firm based out of Columbus, Ohio. I run the Chicago office. And before I talk a little about Loud, just to give you a little background about myself. I'm based in Chicago. I have a 3.5-year-old and a newborn, just 3-week-old. And before joining in the venture capital side, I spent about 18 years on the corporate side with publicly traded companies ranging from clean energy, renewables to heavy industrial companies running corporate development and commercial strategy on the pricing side. And then also did some operation excellence and supply chain. And then made my way eventually into the private side, really starting from angel investing personally over into then joining a venture capital firm, Loud Capital. So Loud is a little unique in terms of how we operate. We invest in early stage companies from Series A seed round all the way to late stage companies doing venture debt, merchant cash advance, factoring. So we're kind of play at all spectrums of early stage as well as growth stage companies as well. So as we go through this panel discussion, I'll share a little bit about kind of how we operate and what we look for in companies and what type of companies we fund in different types of cycles and different vertical pillars that we play in.
Great. Whitney, would you like to give your background?
Sure. Thanks, Jeff, and welcome everybody. My name is Whitney Schmidt. I am a senior associate with the corporate group of the law firm of Seyfarth and Shaw. I started my legal career about 10 years ago with a smaller firm of the western suburbs in Chicago called Huck Boma. And then I lateraled over to Seyfarth about 6.5 years ago. I am originally from the Houston suburbs, and I went to undergrad at TCU in Fort Worth, Texas, and then decided to come to the Midwest to experience winter and to get a new change of pace, which has been proven to be a good decision. I am also the mother of a 4-year-old who is thankfully back in daycare and not at my home every day. And a little bit about my practice at Seyfarth. So we represent, middle market companies in all stages through the life cycle from startup to sale. I started my career a little bit focused more on mergers and acquisitions. So I've helped lots of different types of companies, generally on the sell side, but sometimes on the buy side, selling to strategic and private equity buyers. Most recently, my practice has kind of transitioned to be a little bit more focused on the debt finance space, representing lenders and sometimes borrowers, but often lenders that are lending to middle market companies like CIBC, also Wintrust and a few of the other banks in the Chicago market. And then I also serve as kind of the outside general counsel to companies, advising them on all sorts of, commercial contracts, entity structuring, equity raises, kind of all the things that, a business that might not have an interior general counsel type lawyer on their staff would look to answer their legal questions.
Great. Thanks, Whitney. Alan?
Yes, thanks. My name is Alan Lane Morcia. I'm the SBA program manager for First American Bank. We're a large community bank that's able to offer all the services a large bank can, but with community bank service. I've been doing SBA lending for 20 years. My background is in entrepreneurship and economic development. I think in terms of kids' ages, I'm the old guy because my youngest is 15 and is the only one on the Zoom call right now. The middle one's off at college and the oldest one gave me 3 grandkids. So that's a little bit about me. Thank you.
Great. So I guess to level set, I thought it would be helpful if we put up a kind of a continuum chart that Patrick can walk us through, that was put together by our investment banking group in terms of the different types of capital. So Patrick, if you don't mind putting that chart up and walking through it.
Can everyone see that? Perfect. So we think this is I'll kind of walk through this and start on the right-hand side of this slide. This is kind of where I traditionally play in the traditional corporate banking. And I think of, an asset-based, I think the simplest way to think about it is like a mortgage on a home where you get an appraised value, and based on that, there's a loan to value that the banks can offer. I think that's a good way to look at it. and there's an assessed value. It's very clear. The risk profile's lower, the cost of capital is lower. And as we kind of move from right to left on this slide across the continuum, that cost of capital and that risk profile changes, but so do the rules. So you kind of move away from asset-based to senior secured, which is typically what we're providing with secured revolving credit facilities and term loans, to senior unsecured facilities that are can be cash flow based, and they're measuring your business on, you know, their debt service coverage ratio or their fixed charge. And it's not just the assets of the business where you have a borrowing base structured on your accounts receivable, but on the actual cash flow of the business. And then you keep moving farther down the continuum. So you have mezz providers, the subordinated debt providers. You know, there's typically not set amortization schedule for debt repayments. The covenants may be a bit looser. There's probably an intercreditor agreement set up with those senior lenders on the other side of the continuum. But, you know, payment will just be by interest, but that cost of capital is higher. And then we move further down to common and preferred equity. You know, preferred equity, there's going to be set distribution payments that are going to be needed, but you don't have the voting rights or power that you could compared to common equity. But, you know, common equity, unlike everything else mentioned earlier in that continuum, you know, in a bankruptcy scenario, they're kind of last in line, but, you know, that's the ownership, there's the control there. So this is kind of the world we're talking about. We're talking about access to capital, and the panel and us will kind of discuss kind of the different flavors of all this. So,
great. Thanks, Patrick. You can take that down now. So the world's changed. I'd say 7 months ago, access to capital was pretty easy. You know, really every kind of debt provider out there was climbing all over each other to provide some sort of financing structure for clients. Leverage had been going up. You know, equity was readily available, with many funds being formed to invest in a variety of different types of businesses. Acquisition multiples were about as high as I can ever remember them being. You know, even when there were troubled credits, there was always somebody there to kind of take over that troubled credit and look at it as a brand new credit within their own. So I would say things were very much in terms of balance of power in the hands of the borrower. And here we are 7 months later, and we're looking at a very different scenario, one where banks have certainly been cautious. Equity providers have been cautious. Everybody wants to see kind of how this shakes out before they make major decisions in terms of providing investment into businesses at various stages of that continuum. And it's not that it's not happening, because debt markets are still open, equity markets are still open, but the way that you can access it, I think, has changed over the course. And we're going to explore that through this discussion. And I guess I'll start with Nishad. We talk about it from an equity perspective, and knowing that a lot of the individuals on the line are you know, smaller businesses, probably at earlier stages of their life cycle and otherwise. Maybe talk about how you've seen the equity markets change over these last 7 months, and kind of what your thoughts are on some of the just major factors that are involved in raising some equity right now.
Sure, thanks, Jeff. So yeah, we've seen, so if I go back into how Loud operates, you know, we look at the kind of a high, low, medium risk portfolio as well. So just similar to what the slide was that you saw on there, when we're looking at companies and the stage of companies, we consider our venture fund, our early stage venture fund, a high risk. So that is all equity driven companies that we invest in. And it's ranging from clean energy to medical devices to genetics, to even food industry that we look at in agriculture. So we blend the portfolio, and as we're looking through this, we're trying to understand companies that can truly get to the market a lot faster. A speed to market is a big thing. That's kind of the new IP, the way we look at it. And for us to really invest in companies that can drive that, for us, it's really important to understand what their business development cycle is. We're called Loud Capital for a reason. We're very loud and active in terms of the companies we invest in. So when we're looking at not just writing a check, but really participating with the growth of the companies, we want to make sure that from an equity standpoint, that we can add a lot of value. And there's this good component of a team. So the teams that we look at and the founders are really important to make sure that the companies can successfully grow fast enough that we feel comfortable investing in those companies and taking equity, but also providing them the right capital, the right strategic partner from a VC standpoint to help them develop. So it's really important. Teams are very important for us to look at when we're investing in companies, when we're giving equity or taking equity and giving capital versus just a more of a venture debt type lending experience. So it's very important for us to look at the team. Entrepreneurship, that entrepreneurs that have previous exits are very important for us to see who's on the team, who's on their surrounding them, not only the founder, co-founder, but also other team members that are helping grow that company, especially when you're looking at early stage companies that are looking for funding.
Great. You know, from my perspective, what I've seen, some of the larger businesses have still been able to easily raise equity during this time period. It's been some of the smaller businesses and middle market business that unfortunately have been on the other side of that. And I know many on the line are part of that. And I think more than anything, it's about really understanding your business and the value add that your business is providing. And then how clean you can make your business. And we'll talk more about that as we kind of go through.
Yeah, and just to follow up on that, Jeff, like if you look at just the cycle of what's happening, especially in COVID, I feel the venture capital side, just alternative investments in general, are very resilient to the economy. They're an alternative investment for a reason, so they're outside of public equity. So for us to deploy capital into companies, we also need to raise capital, right? So it has to be a two-way street. So what we're seeing is a lot of large investors are also coming into this alternative investment arm. So we're getting access to capital and for us to then deploy the capital into the right company. So it's really interesting to see how venture funding and just alternative investments have gotten such a resilience around the public equity side and where capital is coming in so we can actually deploy it.
It's definitely a couple different new channels that are being utilized to get capital into smaller businesses.
Yeah.
Patrick, why don't you talk about it from a debt standpoint? Things have changed quite a bit. There was definitely a pause button that was pressed on the early part of this, but why don't you talk through kind of what it's been like for senior debt?
Yeah. I mean, I want to be clear to everybody, like we are open for business, banks are open for business and continuing to lend, but I'll say that quote unquote story credits where an opportunity might not stand on its two legs based on the financials, that probably gives a bit more pause. And if you think about it too, in the world that the banks are operating in, going back to early on, especially in this environment, whether it was March or June, where you're near quarter ends or month ends, the actual banks, credit departments, I don't think we think the world's ending anymore, but we probably did for a couple minutes back in March. They're handling, were handling, a lot of modifications, amendments. We'll talk about PPP briefly as well, but there was just a volume of credit actions, and that probably choked the bandwidth for the banks to probably execute on some newer opportunities. That's kind of cleared, but I think that was certainly something that maybe clogged the infrastructure at first. But we'll talk about too what you want to do to get your business ready for debt financing a little bit later. But again, everyone's open for business, and there's just probably additional diligence and scrutiny from credit, which should be understanding given the economic environment. But deals are still getting done.
Yeah. So I mean, there's a whole group of lenders out there, non-bank lenders that have been salivating over this opportunity right now to really establish themselves as an alternative to the traditional bank. And we've seen that across the board. I know, Nishad, you represent some MCA type businesses. Can you talk a little bit about why they're excited right now and how they might be a source of capital for businesses that are on the
Yeah, absolutely. So many people might on this forum might know about MCA. It's called Merchant Cash Advance, or there's a similar business or term around receivable factoring. It's a huge market. It's consistently growing. There's about 100 to 120 billion dollars in unmet financial need from small medium businesses, from what kind of data we've collected, and it's for funding that these companies need that they typically can't get from traditional banking. Either it's the cycle time is too long, credit markets are now tight, so all these other small medium businesses need money for working capital, for refinancing debt, or for equipment financing, for expansion, for growth, and it could take a couple of months or even longer to get underwritten. So Merchant Cash Advance is another space that we play in, which we will work with private investments or private companies that are not looking to go public, not looking to go IPO, which is like a typical startup, but these are more steady, small businesses that just need short-term injection of capital. And we're able to look at their cash receipts. So not so much looking at profitability or EBITDA, but we're more looking at their cash receipts, their transactions, for us to really come in and deploy short-term capital for them to get a jump start. And then when it's the right time, we can exit them out and hopefully graduate them over to an SBA loan or a traditional bank loan. So we play in that space a lot. We've invested in over 450 plus companies across all 50 states, ranging from professional services to transportation logistics companies, to food industry, food industry meaning like more, B2B type food industry businesses. We've done a little bit of B2C in terms of end consumer, like restaurants and hospitality, but not so much. We didn't have that big of a portfolio during COVID times, so we didn't get much really impacted. We deal with more professional services such as contractors, construction companies, working with government contracts. We do a lot of that. So it's been a huge market. It's continuing to grow. The Merchant Cash Advance market year over year is growing. It's about a $24 billion market right now is where we see it, just ending in 2019. And as the banks get tighter, that market's going to continue growing into this year and the following years.
Yeah, just the same. There are factors that rely on your receivables. So it's more a function of really purchasing your receivables from you to help you shorten that working capital cycle. Small non-bank asset-based lenders are also very much available in this market, and that the factors in that smaller asset-based lenders, non-bank asset-based lenders are willing to look at earlier stage companies or companies that have a story. But really, they're going to be looking to your assets as the primary way of lending, and they're a bit more expensive than the traditional bank. We bring all this up because the traditional bank is still available. It's just more difficult to access that capital than it had been in the past. And so if you have the time and the patience to work through it, it's going to be a cheaper source of capital for you. But there are other alternatives that are certainly geared up and are excited to lend during this time period. Whitney, from the legal perspective, can you talk about some of the changes that have taken place during the last 7 months of COVID and how they've impacted maybe access to capital?
Yeah, so I can definitely echo Patrick in, being on the legal side of preparing all of the loan modifications and things that, we were working through in April and May as the banks were looking at their existing credits and figuring out, how to address the second quarter and just how weird it was. And usually the case was to either, modify loan covenants, basically maybe restart the build on covenants to basically just, let's not even look at Q2 because it's such an outlier, and just, start covenants over, defer term loan amort payments. Those types of modifications were ways that banks were just, servicing their customers and kind of all weathering the uncertainty that was the beginning of COVID. And I will say, I work with banks lending to specialty finance companies, and we have definitely seen how the specialty finance companies, the non-bank lenders, have been also modifying their loan programs to be able to also weather the changes in the marketplace. So that from the senior lenders perspective, that has been a way that we've modified the borrowing base that the senior lender is lending to those companies. And there's been just all sorts of creative ways that I think everyone is kind of looking at, the market broadly to try to be proactive about, trying to anticipate the things that are changing and how to address them. But I will definitely say it is true that, we are doing new deals. And, I was definitely excited to see that we were doing new deals. I started my legal career at the beginning of the last recession, and I know how everyone feels that this is a different type of downturn than, the Great Recession was. And I think that just going through the past few months has definitely been indicative of that. There are good companies that were doing great before COVID, and as the keynote speaker at the beginning of the morning, I said there are companies that have been able to pivot and grow and be even better because of COVID. So I think that there are definitely still, lots of opportunities, and I think it's just everyone from, lenders, service providers like myself as a lawyer is just trying to be creative about how to see the bigger picture of everything and kind of work through everything.
Yeah, I mean, I definitely want to echo the positive note. I think now that we've been through a period of time now, we've kind of got a perspective, and I'm saying as a capital provider, of the types of businesses that are going to survive through this pandemic better than others. And we certainly are in the business of making loans. Our budgets for the next year, and I've talked to other bankers as well from other institutions, are every bit as high as they have been in the past. There's going to be a desire to get out there and start making loans, and we're seeing that already happening. So there is a feeling now that we are at a place where we've seen enough stability, or at least instability in certain sectors and not in others, that we can make some decisions about how we would look at capital providing. So the government has become part of the overall story. And Alan has spent a good portion of his career in the SBA. As everybody had heard about, the PPP was an interesting process, but I think one that was very successful ultimately. We're now in the state of forgiveness, but I thought it might be helpful to hear from Alan just on his general thoughts about how the PPP went. But more importantly, now that we're all thinking about the government potentially being a part of this access to capital, and one of the presenters mentioned it earlier today in terms of taking on SBA loans as a way to kind of start off a business, talking about some of the other different types of SBA programs that exist that may get a lot more attention now.
Right. So, I mean, I've been doing SBA lending for 20 years now, and the PPP loans were nothing like SBA lending that I've ever done, because there was no due diligence. It was all, give us your information, certify that this is what you're doing, and we just verify the numbers and there's the loan. Obviously, that's going to affect a lot of businesses on the forgiveness side, because they have to document how they spent the money. Did they use it appropriately? Did they cut payroll? Those are the kinds of things we have to look at on that side of it. But traditional SBA lending has actually increased during this time too. Part of that is because lenders may not be as comfortable with a credit as they would have been in normal times. I mean, we still look at all the C's of credit. So cash flow is always number one. We are always looking at that. That hasn't changed. We're still going to look at the individual and the business credit. We're still going to look at collateral. SBA is always, collateral is last, because if we're able to do it conventionally because there's sufficient collateral, we don't need the SBA. The big change is conditions, because that is always part of our credit. And if the conditions have obviously changed for everybody. So we have to look at that on a business by business, and we also have to look at that industry by industry. So if the industry's been affected, we need to know what's going on. It's made it really important for people to keep their business plans updated. Sometimes people will do a business plan, put it on the shelf, and then sort of move on with life. I've always said business plans need to be living documents, now more than ever. SBA last month came out with new guidelines that we had to follow with regard to the conditions around COVID. And part of it is, did they get a triple P loan? Did they get an EIDL loan, which is the economic impact disaster loan? And then how have they been impacted by COVID? And if their financials from last year aren't reliable based off of new conditions, we need an updated business plan and we need updated projections to see what's going on. So that's a lot of what's going on right now, as well as, you know, we're involved in the whole forgiveness process, and then not knowing what Congress may or may not do to make that easier, and whether or not there might be round 3 of the PPP loans, we don't know. There's a lot of things that are up in the air. That whole program was basically flying the airplane while it's being built. But like I said, SBA loans are increasing because traditional lending bankers are getting a little more concerned. And so they like to have the government guarantee behind it.
Great, thank you. So I want to make sure we touch on M&A a little bit. And it's a difficult topic because there just hasn't been a lot over the last number of months, particularly in the smaller to middle market arena. And I think part of that has just been the uncertainty that existed, similar to access to capital within that market. It paused for a period of time. But I think so much of it, and we're going to dive into this a little bit here shortly, relates to preparedness and how ready you are as an institution. But I guess before we get into the preparedness side, I guess Nishad, why don't you talk a little bit about M&A from your perspective right now for this market, and when you kind of expect it'll start to pick back up again, and how you view valuations and multiples.
Yeah, so some of that has slowed down a little bit as companies are trying to refocus on their strategy. You know, it was mentioned in the keynote as well, and I think Whitney mentioned as well, just around how companies are pivoting. There's interesting companies kind of changing their mission, their strategy. So I think the M&A and that whole strategy has slowed down, but I think it's going to pick up coming into Q1 of next year, especially on the private side for kind of early stage startups to kind of mid growth startups that are going to be eventually going into a private equity type exit. So we see that kind of happening starting end of Q1 as that starts picking up from our perspective in the private market. We see some of the companies today that are really focused on kind of looking at companies that they can partner up with. So maybe not doing an M&A. So since this COVID time has become like hey, how do we pivot a strategy? What should we be focusing on? What they're doing now, I see a lot of private startups and private companies, small businesses, collaborating and working together. Maybe as a formal or maybe an informal way of doing like a JV and working together to survive and find different ways to pivot, and then eventually say, okay, this partnership works, let's get engaged today, and then we'll get married maybe in Q1. That's where we see what's happening in the private space today, with just startups kind of partnering together, coming up with creative ideas, joining forces, and eventually finding a way to kind of partner. We see that kind of coming down the pipeline in what we're seeing with a lot of our companies in our portfolio today, as well as some things that we just heard from just the industry. So it's a good strategy to think about as companies or people on this panel. Are there other people in the market, other companies in the market that you can partner up with and join forces to kind of grow the company, and eventually look at how you can raise capital together and go as a collective force, and then maybe join as M&A and come up with a JV strategy down the road.
Great. Whitney, any thoughts on that, and you know, any kind of structural changes that, or even going into the preparedness of these businesses for M&A or for capital raising that you see from a legal standpoint?
No, I think, you know, this is kind of a good time that, you know, you might not have, you know, the potential exit as close to the pipeline as you thought it was. It's a good time to take kind of like, look at your organizational structure, look at your contracts. Do you actually have signed contracts with your biggest customers? You know, a lot of times you think you've actually executed a contract, but you go and you look at your files and you're like, oh, we don't actually have the fully executed one back. Those are things that, you know, a buyer, as they get into due diligence, will obviously be focused on. So now is a good time to kind of assess yourself and get yourself, you know, ready for a potential transaction. I also think it's a good time to make sure that, you know, your corporate housekeeping is in good shape. You know, sometimes, you might have, formed a company, you started an S corp back in the day, but actually the tax benefits from the S corp might not be as beneficial to you with the tax changes and things. You might be potentially more, make sure that you have, and I think Patrick will speak to this too, you need to make sure that you have good outside advisors like accountants. This is a good time to just make sure that the way you started to do your business actually still makes sense as you've grown your business, as you've maybe taken on, an additional partner to your business, as you've maybe transitioned away the founder because that person's retired. It's a good time to just get a full picture of everything that a buyer might be looking at. You can kind of approach it as, if I was looking at your company fresh, where are the red flags or not even red flags, but blank spots that is good to make sure you actually have documentation or planning to fill in those gaps to be able to tell your full story. Because you don't want to get into a process and you value your company at X, but a potential buyer is going to totally discount it just because your record keeping is a little bit sloppy. Like that's a simple way to not leave money on the table. So I think, in this, slower period, I think it's just a good time to kind of think about those types of things strategically.
Thanks, Whitney. And I think that goes along even with what Doug said on the line earlier in his presentation, looking at a lot of businesses, looking for clean businesses, and having a clean business means a lot of different things. Patrick, talk a little bit about what we would look for in a business as we're considering providing capital to them.
Yeah, so I appreciate that. When we're, looking at a company, typically as a requirement, it's 3 years of audited, at a minimum reviewed financial statements. And we're looking at, kind of alluding to what Whitney was saying too, but the structure of the business, we're also taking a look at the management team. I mean, we're a relationship bank, and it's been interesting in COVID getting to know prospects because you're not seeing them out as often. But we're building a relationship, and we want to know you and your business, and that takes time, lots of conversations, and we want to dig into both you and the business and the numbers. And when we're digging into the numbers, we need to trust that internal reporting. So it's not just the audited statements at year end, but it's your internal reporting. And depending on the type of business, to be able to close a loan, there's additional diligence that might be needed. There might be field exams to look at the AR for building a borrowing base, or appraisals needed for equipment or property. And just like you measure your business by keeping track of key performance indicators or KPIs, that's data that's valuable for the banks to know and track also. So if you're a steel company and you're dependent on the price of steel, and that has an impact on the margin of your business, that type of data is always helpful to share for the banks. And we're going to, if we're doing our job from a diligence perspective, we're going to ask for information like that. So it's an open and honest conversation, and it's a good process to go through. But I think it really does start with clean financial information that goes a little bit to the service providers you have. So and we can talk about it a little bit later, but it's the quality of the management team you have, and then your third-party providers, whether they be the accounting firm you work with, the law firm, and your banking partner or other credit provider.
Thanks, Patrick. Alan, if you're looking for government, SBA type debt, what are the types of things you need to be prepared for in that process? What kind of documentation? What is necessary to make that happen?
Well, one of the things about a government program is they like you to pay taxes, so we have to see everybody's tax returns. So even though we like audited and reviewed statements, we're required by the government to get tax returns, both for the owners as well as the business. So that's the big thing that we got to get in terms of financials, plus your most recent internals. SBA has one form that we're required to have you fill out, which basically tells the business history and the history of the individuals. making their citizens or permanent residents and, you know, haven't committed any major crimes. So those are things we have to look at. But the underwriting is the same. We're looking at the same things that on SBA as you do on any kind of conventional bank lending. On the M&A space, one thing that I've seen a jump in is not stuff from the outside, but from the inside. Partner buyouts or management team buyouts. Those have actually jumped up recently. And part of that might be that I'm seeing more because, again, SBA, it's a government guarantee, so the bankers are a little more comfortable having that. But I'm not seeing those outside buyers, but I am seeing inside buyers, which is fascinating. Another thing that there's a big jump in right now is the 504 program, which is SBA's program where you can buy building or heavy equipment with only 10% down. Part of that is that there are people that just like want to get rid of their buildings. And so like if they're renting, if you're renting your business and you want to own the building, a lot of people are doing that. The big benefit right now is that's got a first lien position with the bank and a second lien position with the SBA on 40%. That 40% is right now under 3% fixed for 20 years. That is really cheap money. So a lot of people are wanting to jump into that program right now.
Great, thanks, Alan. Why don't we get into pitfalls a little bit? That was an area that was highlighted as that the people would like to talk about. Nishad, can you talk about some pitfalls, maybe even related to, you know, management team in terms of their, you know, ability to access capital, or just, you know, in the process of M&A or access to capital, things that you've seen go wrong in the preparation or process?
Yeah, so maybe I'll share a couple examples. One on the equity side from our venture fund, and then maybe talk about MCA pitfalls that we deal with as well. So on the equity side, when we're involved at funding early stage companies, there are no financials, right? There's pro forma. And pro forma is sometimes whack. You don't know. People put some, you know, estimations down there 3-5 years from now, but you never know what could happen. Nobody could impact even a pandemic that's going to happen. Something else could change as well. So we don't really look at financials. From a pitfall perspective, we really look at the team and the concept of the idea, right? So how quickly can they convert over to sales? And a lot of times we've made bad decisions. If you look at a venture fund, typically 80% or 90% of the portfolio fails. If you look at early stage funds, and only 10% succeeds. The 10% that does succeed are going to drive astronomical results and returns. So we do see a lot of pain in companies that don't make it through. And the number one reason is around the team for us. The founder, co-founder have to be well invested from their time and the concept of really driving this through into execution and then eventually converting it into sales, or to take the concept all the way through fruition for a licensing deal or an exit. So for us, not understanding the team, spending time with them, you know, putting the other financials and things aside, but really understanding the concept and how they're going to drive execution is very important for us when you look at early stage venture companies that we invest in that are maybe driving, you know, $1 to $2 million in revenue eventually, and all the way up to 10 as we're investing in these companies. On the late stage side, we look at venture debt or MCA. A lot of areas that we try to focus on is understanding, obviously the financials do come into play. So we do very similar due diligence as a bank would, where we look at their last couple of years of bank statements, financials, tax records, their background check. And things that sometimes do go wrong is over leveraging them, right? So MCA and receivable factoring is a little different. It's a little more expensive, and it's not for everybody. It's not for every type of business. And they have to have a fast kind of transactional type business to be able to afford some of these MCA loans that come in that we're offering. So sometimes when we look at companies, we see there's other MCA or other lenders already on there as first or second position. And when we come in as a second or third, that could typically over leverage the company or put them in a tough spot, which eventually could take the whole business down or have them suffer from a cash flow perspective. So we've seen a lot of those issues come across as businesses right now in the COVID period are trying to ask for capital to come in when they need something just to survive and get through. And we know these companies are great. They've been around for years, even decades. And how do we help them? And we have to sit down, really make sure that we take the right due diligence in understanding how they're over leveraged, which other MCA players are they on with those specific terms, and how can we buy them out. And sometimes we've seen those issues come across where we've lent to companies and then it didn't work out, and then we had to obviously write that off as a bad debt. So it's very important for us to see other MCA terms or other MCA lenders on their books and how we can potentially buy them out to avoid those pitfalls on the late stage companies.
Great. Whitney, you want to talk about some pitfalls?
Yeah.
You obviously are the front line of a lot of things that can go wrong during a transaction, but
that is true. I have kind of two examples that come to mind, one in M&A and one on the debt side. So on M&A, one potential issue, especially with a company that might have a small team, is that, you know, being on the sell side in an M&A deal is almost a full-time job in itself. And often, you know, it's a CEO or a CFO that's trying to be the liaison person to manage the M&A process, and in their focus on doing the M&A process, they can turn their attention away from the business that they're running, and then suddenly they have bad performance that quarter because they were doing an M&A deal, and you know, it spirals from there. And I've actually had 2 deals in my career that, you know, there are probably some outside factors also, but that basically deals that didn't close because of some of that issue. So I think, you know, being kind of aware of that reality and making sure that either if that person that needs to be the person that's running it on the business side, making sure that they've sufficiently got backup of other people that are kind of covering them to run the business if that's available. Being realistic that the process is an involved process and will take a lot of time away from running your business, which also just underscores why preparation is very key. And I think, and this kind of pivots to my second pitfall, is letting your service providers do the job that they do. I see this on the debt side of things where companies will try not to use, because on the lending side, often borrowers will pay the fees of the law firm that is, you know, doing the deal for the bank, and also your own law firm that's reviewing your loan documents and doing your deal. So you're kind of, unfortunately, it's the nature of the business, paying for quote unquote paying for 2 lawyers. So I see borrowers often try to do a lot of the things themselves, when if they would just let their law firms do it, it would probably end up being more efficient because it'll be right the first time, and not, I get drafts, I'm reviewing it from the bank's perspective, I have to totally redo them because they're just wrong because, you know, a non-lawyer was playing lawyer. So I think it's important that you select, you know, service providers that you trust, that you know will give you value. And if you don't think that they're creating value to you and they're too expensive, that's the negotiation that you can have with your law firm. But don't just think in the name of efficiency or keeping the bills down. Doing it yourself will actually be cheaper, because I've seen it time and time again where it just doesn't end up being, it's just less efficient. So let us help you is my advice.
Jeff, I'm going to echo what Whitney is saying. You need the right service provider for your business, and you need to trust them to do their job. And don't get an attorney who's your divorce attorney. Get an attorney who's a corporate attorney.
Yes.
I've run into that one a few too many times. Get a CPA who's right for your kind of business. You know, ask the questions like, how many businesses of my size do you work with? And you want that number to be pretty substantial. You know, we're running into things where people are doing it themselves, and they put in the triple P loan as income on their financial statements. It's not income, it's debt. It will switch over once you're forgiven, but you're not forgiven yet. No, the SBA has not sent for forgiveness on anybody yet. The banks we're submitting forgiveness. SBA has 90 days to send it in, so nobody's getting that money yet. So your financial statements need to reflect that it's debt. And you need to have a good CPA that knows how to do that. So you need to have the right advisors and let them do their job.
Yeah, I echo, don't have a litigator do your M&A deal, because it never goes well. They may be a perfectly great lawyer and they can read contracts. I'm not gonna say they're not good lawyers, but they come at they come at the transaction with a very different adversarial mindset versus a collaborative mindset. And I just think get a lawyer that does what you need them to do. Even if they're your best friend, it's better to have the right lawyer for what you want the task at hand.
So Patrick, just piggybacking on the conversation regarding the PPP forgiveness, I'm assuming that many people on the line had received PPP related funds. How are banks treating that forgiveness, at least in concept, related to debt covenants?
Yeah, so typically, take a neutral approach. So what we're seeing is it's not counted back as EBITDA, and it's, we're operating under an assumption that it'll be excluded from debt unless it's not forgiven. So we're kind of talking about how second quarter results in particular, there's a lot of noise in them. The PPP is a unique thing. So you're kind of operating, we're kind of operating almost as if it's not impacting them unless we have a situation where the funds aren't used for the correct purpose or something of that, or whatever portion's unforgiven. But the banks are just trying to take a neutral approach to it because our covenant structures want to measure, business as usual, and the PPP is a little bit of a unique animal there.
Yeah, and I will say also, I'm actually currently on an M&A deal that's in process, and the buyer on that transaction, the way that we're approaching it, because they did get, a sizable one, not a max one, but, big $4 million PPP loan, so, a significant one, that the buyer is basically requiring a full escrow of the amount until the forgiveness happens. So basically, kind of neutralizing the fact that it happened, and that's the way that, at least the proposal of how it's going to be addressed, just from the M&A perspective of how they're looking at the impact of the purchase price that they're paying.
Excellent. So there was a question that just came up in regard to the Main Street lending program. So Alan, I'll look straight at you to say, is this program operational? Is it effective? Are people utilizing these funds?
Thanks, Jeff. So a lot of banks officially register for the Main Street program, but then when you look at the conditions and the terms and everything that go along with that program, we're finding out that it's not as beneficial as it looks on the surface. It's not a forgivable loan like the PPP. The EIDL loan that came directly from the SBA has much better terms, and many times a conventional bank loan is a better deal than the Main Street program. They just put so many conditions and so many things on it that it's not necessarily beneficial. We actually, even though we registered to do the program, we haven't done any because we haven't found a point where it's going to be beneficial to our customers.
Yeah, we're very frustrated by it institutionally. A lot of our clients have inquired. Many of them like certain aspects of it, but there's other than teeth associated with it that just make it a very difficult program to enter in, especially if you plan to be acquisitive in the future, if you potentially will have ups and downs in your businesses. All of a sudden, you're not just dealing with the bank. In fact, the primary lender to you in that case is the government, and it's the government being assisted by another outside, private equity hedge fund type oriented structure. So it's a very challenging program as it states, but because there's so much money wrapped up in it, I won't be surprised if there are some modifications and tweaks to the program that eventually will allow those funds to be available. So I would just stay tuned and keep listening for updates related to it. In the meantime, as Alan mentioned, there are other governmental programs that are available. And I think banks are really trying to be flexible with clients that have dealt with COVID-related issues. Our regulators thus far have been very accommodative, I would say, to working with us. And we haven't had to do a tremendous number of downgrades. And a lot of the modifications that we've done have been viewed as just understandable related to what has happened in the overall market. So that's a long-winded answer to Main Street. So far, I don't think there's been much usage at all of that program. If there has been any usage, I think it's almost been forced usage where certain banks have been pressured to put those funds out, and I just haven't seen it in any great sense. So I guess, Patrick, do you want to talk about some pitfalls from your perspective?
Yeah, and I'd like to kind of piggyback on something Whitney was talking about earlier with regards to legal. I think I understand from a borrower that the legal bill is going to be, if not the biggest, one of the biggest expenses you face, and people try and do all they can to tamp that down. But I think one good thing and strategy for business owners to have an open and upfront conversation with the bank and ask for a quote on the front end and kind of stick to that budget. And what is a not successful strategy, I would say, is having the attorneys separated for a long process, especially if you're talking about something like an M&A transaction or an activity such as that, because there are a lot of business points that can be negotiated and discussed between the bank and the business and consensus built. But you need the lawyers to be in the same room or on the same conference call or Zoom call to hammer out some details. And I've seen too many times where, the borrower's saying, hey, we don't want we don't want the most expensive phone call where I'm paying for beyond it. Let's hold off. And suddenly you're a week or 2 weeks away from when you think a deal's closing. Everyone's on the call for an all hands call, and there are huge deal points that are then identified and need to be worked out at the 11th hour, where I've seen completely new, documents need to be drafted, new structuring, new approvals needed from the banks internally. I don't have, one example. I have dozens of examples I could probably add. And I just think it's a little bit, we totally understand from the expense part, but it's kind of penny wise, pound foolish. And that's where I think you need to have a good communication with the bank upfront about that. And you can do things to, with the, getting a cap or discussing things like that to reduce the risk of that piling up, but you need to get the attorneys engaged and communicating, because it'll just make the closing process smoother. And Safe is great at that.
Thanks. Yeah. The inevitable when the lawyers finally connect and you get on the phone and you realize, oh, we actually need the borrower structure to be totally different because there's actually these two subsidiaries that nobody knew about, and oh yeah, that subsidiary owns all the IP, and suddenly we got to do new searches, and oh, we were trying to close in 2 days, but now it's a week later. Like, those are conversations that are just easier to manage on the front end. And I know I take an extremely collaborative approach, and most lawyers on the other side of the table also do. So yeah, just get all the details out in front of everyone early in the process, and it always ends up going smoother.
So we have about 7 minutes left. If there's any questions that we haven't addressed, please put them out in the chat, and we'll try to get to them right away. And post, if you have further questions, please feel free to email or call any of the panelists, and we'd be happy to walk you through at least our view on certain aspects of access to capital. Certain things I think you need to be aware of when going out for debt at this point, or any kind of instrument that has a debt attached to it. There's likely going to be a LIBOR floor in place. That's been a nuance within COVID that we've seen across the board as interest rates have dropped pretty drastically. For banks, interest rates have gone below the point of sort of really the cost of capital for most institutions. So a lot of banks have instituted, and I say a lot, majority of the banks have instituted LIBOR floor mechanisms. We're also going to see LIBOR going away at some point in the not too distant future, and many of the documents have language to address that. Whitney, do you want to talk a little bit about that?
Yeah, so most banks, if you do have an existing credit, you might be seeing a loan modification coming down just to make sure that there's appropriate language for SOFR, because that's probably going to be what the new benchmark is. So don't be surprised if that's a request. And yeah, I would definitely echo Jeff in that we're seeing floors being put in. It ranges from 0 to 1%, just depending on, the type of borrower and things. But, it's definitely, and it's surprisingly the LIBOR replacement process, up at this point has not been delayed because of COVID, which I think was somewhat surprising, at least to me. You would think this kind of disturbance in the marketplace would push it off, but no, it's still kind of on track to be replaced in the near term. So.
Okay, and I guess maybe final word from each of the panelists, just in terms of overall view of the market. Are you optimistic? Are you cautious? Are you negative minded? How are you viewing the market over let's say the next 6 months?
Sure, this is Nishad. I'll go first. So overall, from a private venture perspective, if you look at just the investment cycle and what's been going on, venture puts in about, it's really a small 0.2% of GDP is what, if you look at it from an investment dollar perspective, but it drives about 21% of the GDP outcome from companies that are backed by venture, whether it be venture debt or venture equity in terms of taking equity from a early stage company. So it's a huge number in the output. But it's a small number from an upfront investment standpoint. And we see that to continue even as we come out of this, post-COVID or during COVID cycle. The venture debt side is extremely booming, and it continues to boom into 2020, and I think it's going to continue to next year as well. So there's going to be a lot of capital, access to capital, especially on the private side from my lens that I look at, that companies are going to be continue to coming through for equity positions or for debt financing from the venture side. So we see that momentum to continue into 2020 for the next second half of the year.
So I think, especially on the M&A side, I think it will continue to be, a slower market, especially in Q4. I'm hopeful that, that isn't the case and that there's some uptick. But I think, as the utilization of the PPP money and the CARES Act, kind of coverage kind of winds down, and that there's just less support from, governmental support in the marketplace, I think we're going to see, unfortunately, kind of the next little wave of everything kind of, level setting. And I think that will kind of impact, deal activity. But I still know that there's, lots of money that was sitting, dry powder on the sidelines ready for deals before COVID, and that money hasn't necessarily gone away. Some of that money might have been put into, existing portfolio companies that private equity companies had to kind of prop them up a little bit. But, I think it's still there. So I think I would say I'm trending on the slightly pessimistic, but I'm an optimist at heart. So, dialing it up just a little bit, but being realistic, cautiously realistic.
Alan?
It's one of those weird times being an SBA lender, because I've seen this happen before, where when credit gets tighter elsewhere, that's when SBA goes up. Because one, you now have the PPP program, people are more aware of the SBA and other programs that the government has. And then two, having the government guarantee is going to make lenders a lot more comfortable with a credit. And the fact that most businesses are going to qualify as a small business under SBA size standards. I mean, it's, we're talking, depending on the industry, 500 employees is still considered a small business. So I think SBA goes up when everything else starts to shake a little bit. So I'm going to be busy.
Patrick?
Well, I think the elephant in the room too is there's an election in November that everyone seems to forget about. So there will be certainly an impact there that people have to be mindful of. But, we were talking about, I think I'm less concerned about small, medium-sized businesses than I am maybe individual consumers. And we're talking about stimulus and additional unemployment benefits. kind of expiring or running out, and just municipal governments, state governments having less tax revenue. So we haven't seen that yet, but we're starting to hear about it, and we know in Chicago the budget issues they're going to run into. You know, that lever that they're going to maybe end up having to pull is layoffs and all that, and we haven't seen that hit the market yet. I'm a little bit concerned about that, and then the impact that has on consumer-facing businesses. But you know, our bank balance sheets are much stronger and well capitalized than they were in the last recession. I think larger businesses in particular are going to be weathering this well, and frankly, a lot of small and medium-sized businesses. So I'm less concerned with how corporations will weather this, and more concerned with maybe individuals.
So just to wrap it up, I'm optimistic. I think banks and financial institutions want to lend and invest in good businesses. And I think that will always be the case. So the better you can prepare your business for that, making sure your financials are clean, making sure you're working with the right partners, you know, focusing on the core of your business, making sure the management team is right. I think you're going to find equity partners and banks and other financial institutions that are willing to work with you. So thank you everyone for joining on. Enjoy the next panel. Appreciate everyone being part of the symposium today, and look forward to meeting you in the future. So thank you.